Talking of global cues and investing, we have a big global voice joining us on the show, a special which we have lined up for you. Morgan Housel joins us from Washington. Just to tell our viewers that Morgan actually shot to fame as an investment analyst at the Motley Fool. Now, of course, he's a partner at Collaborative Funds, but is very well followed on social media via his blog and on Twitter. He's joining us live from Washington, D.C. Morgan, thanks a lot for your time and good morning there in Washington. Let's talk about how you are analyzing the investing environment right now. You're based out of Washington in your own backyard. Lots of cues are being thrown about regarding the market, Trump triggered rally, all of that. What are your opening thoughts right now?
Good question. And first, thanks for having me on today. I would say no matter what is going on here in Washington, what's going on with politics, both in the United States or globally, it doesn't have a big influence on my investing process. And this is an important point because I think it's one that really does influence and sway a lot of investors over time, is they look at the current news, what's going on today, this week, what's going on with politics, what might happen next quarter, and they use that information to guide their investing process. And that, I think, is just inherently a short-term version of investing that I would not advocate. I'm really looking at what are businesses likely to generate in terms of profit and cash flow over the next 10 or 20 or 30 years. So here in the United States, obviously, we have a presidential election every 4 years. So for me to look at what the current president might be doing and how that's going to influence the market doesn't really factor into my thinking because I'm looking at the next 30 years, and we're going to have another 5 presidents over the next 30 years. So to answer your question, when I look at what's going on, I don't pay attention to many of the variables that I think a lot of the investment media would focus on. I don't really pay any attention to quarterly earnings. I don't pay attention to what the economy is doing this quarter or even what the economy is going to do next year. Basically, my framework as an investor is I'm investing for the next 20 or 30 years, and I know as almost a matter of fact that during that 20-year period, we're going to have several recessions. There's going to be periods where businesses don't do well. There's going to be periods of political upheaval. There might be, heaven forbid, wars during that period. There's going to be a series of unfortunate events during that period. But I know that, or I'm highly confident, I should say, that over the long course of that period, stocks and investments will do not only well, but extraordinarily well. So that's really the foundation of how I invest.
Well, that's advice well taken, but it's so hard, Morgan, to actually, blind out what you're seeing from the Donald Trump camp. But let's talk about closer here at home. What are your thoughts on emerging markets, the way we've sort of performed in, of course, the last, say, 5 years or so, and how does it compare to the DM performance?
Yeah, the rally that has taken place over the last several months, I think, is interesting just because so few people would have predicted it. But that's been true about the rally for the last 8 years that we've been having. I'd say the entire rally has more or less been unprecedented and unpredicted. And the rally that we've had in the last 3 or 4 months is pushed U.S. stocks up about 10%. If you look historically, how rare is a 10% rally over a 3 or 4 month period? Not that rare. So I think it's really surprised people over the last couple months because they didn't think that if Donald Trump won the presidency, stocks would do extraordinarily well. But I think if you look at the long stretch of history, it's really not that rare. Now, if you look at markets in terms of valuations, in terms of, it's been so long since we've had any kind of bear market, does that make markets stretched and maybe more prone to a pullback in the near future? Maybe, but I think we have to reflect on the fact that has been true for the last 8 years. That at basically every moment since 2009, stocks have looked overvalued, overbought, overstretched, due for a pullback, and it hasn't come. And that's not to say that it's not going to come. I think it absolutely will. But I think it's just a good reflection that we as investors should advocate more humility than we often do, and recognize that pullbacks and rallies come at unpredictable times that oftentimes don't make sense that we can't justify. But because they don't make sense and we can't justify them, we should be less willing and trying to predict what's going to happen next, to predict when the next pullback, bear market, recession is going to come next. It's really tempting for investors to look at the current environment and say, where are stocks today and where are they going next? I really just advocate, this gets back to what I was talking about before, kind of a hands-off approach where I accept that these crashes are going to come inevitably, but I have no idea when, and I don't attempt to say when. In terms of emerging markets, I think in general, whenever you have an asset class that is rooted in an economy that has higher growth than developed markets like the United States, you should expect higher returns over a long period of time. You should also expect substantially more volatility over time. And that's easy to say. It's harder for investors to put up with that and deal with that in real time. So I think over the last 3 or 4 years that we've had a lot of volatility and kind of a flat line in emerging market equities, it's hard for a lot of investors to handle that. And a lot of investors throw up their hands and say they don't want anything to do with it. But I think that's the price that you pay for higher long-term returns. So I would expect that if you look at a period of 10 or 20 years, you would see higher returns in emerging markets than you would in the United States. But a lot of investors won't actually earn those returns because the volatility that takes place in between will be enough to scare them out.
Right. Morgan, there are two kind of essential participants in the market, in any market, India in particular, who are watching this interaction with you. One is the trading community, the intraday traders, the positional traders, and the other one, of course, is the value investor with a horizon, long-term horizon and keenness towards benefiting from compounding, the principle of compounding. How do you analyze both these communities, and what do you have to say on the merits and demerits of each of them?
Well, certainly, just as a matter of fact, wealth is made in the long term. Trading back and forth is a zero-sum game. So some people will win, but it'll come at the cost of other people losing. So there are traders who make money, but there's an equal number of traders who lose money. So if you're willing to take that gamble, then maybe it's for you. But I'm much more interested in games where the odds are stacked in my favor, where it's not a 50-50 proposition of whether I'm going to win, but I want to play a game that has a 70 or 80 or 90% chance of me doing well over time. And those, by an overwhelming majority, that is where those odds are only found in long-term investing. So I think if you're playing the short-term investing game, at best you might find games that are 50-50, or maybe you have a 51% chance of winning. But if you're looking for games where that have a 90 or even 95% chance of winning over time, which is what we've seen historically for equities, that's long-term investing.
Well, trading, Morgan, might be a zero-sum game according to you, but you've mentioned in the past how the urge to keep doing something does more often than not cost traders a whole lot. But the fact is that a large section of our viewers are active traders. So, so to that extent, what are your thoughts?
Well, there's nothing wrong with trading. I think everyone needs to find an investing process that works for them, that fits their own goals, that fits their intellectual curiosity, and maybe that fits some element of entertainment that they want to engage in. So it's not for me, but that's not to say it's not for other people. But I would say if you are in a trading activity, I would encourage you to view it as a zero-sum game where your win has to come at someone else's loss. And if you view it that way, then you have to say, what information do you have that the person on the other side of the trade does not? What intelligence or information do you have that they don't? And I think if you're really humble and honest with yourself about it, you might not be able to answer that question, and it might change your perspective about the act of trading versus long-term investing.
Focus, Morgan, to compounding, the principle of compounding. What are your thoughts on it? This is one thing which a lot of people have read a lot about, spoken about, but little understood. How powerful can it turn out to be for investors over the long term?
Well, I think the power of compound interest is always something that surprises me. It's not intuitive for human minds to think in exponential terms. They think in linear terms, so 2, 4, 6 rather than exponential 2, 4, 8, 16. And I think since compound interest is not intuitive, it's hard to grasp how truly powerful it is over time. But if you just make a spreadsheet and look at the numbers, the huge gains in compounding don't tend to come after 1 or 5 years. They come after 10 or 20 or 30 or more years. So that's really where, if you want to get rich in investing, in my view, you have to take a long-term view. And by long-term, I don't mean 1 or 2 years. I mean 20 or 30 years. Now, the majority of investors don't have that kind of patience. And a lot of investors don't even have that kind of time because they're already in their 60s or 70s. They're already retired. So they don't have 30 years in front of them. So to me, really, the biggest investment gains come from people who start saving at a young age, save consistently, and do it through their entire life. And if you're not able to get to that point, then compounding works against you. The other thing I would say about compounding is that it works in reverse as well. So if you think about the power of, the difference between earning 12% a year and 10% a year over a long period of time is enormous. Just a little change in your annual return, but if you do that over 30 years, makes a huge difference. And if you think of it that way, you become much more sensitive to things that are pulling your returns down, like fees, costs, trading commissions, those things that pull your annual returns down by a little bit, 0.5% or 1% per year. If you do that over 30 years, it's life-changing. So when you think of it that way, when you think about the power of compounding over time, you become much more sensitive and aware of fees and trading costs as well.
What is that?
Okay, let's talk about, Morgan, what, in your experience are some of the mistakes that investors oftentimes make in their process of investment?
That's a great question. I think that the biggest mistake that people make, and I mentioned this before, I'm going to repeat it because I think it's so important, is people not understanding their own risk tolerance. And it's easy, and this is something that I dealt with myself over the last 10 years. During a bull market like we're going through now, it's easy to say, I have a high risk tolerance. I want to own lots of stocks. Maybe even I want to own them on margin. And you can tell yourself, if stocks were to fall 10 or 20%, that's fine. I'm okay with it. And then it actually happens and you're not okay with it. It hurts. It's painful. It may even be so painful that you end up selling. And people, I think it's easy for investors to underestimate how much of investing is not about numbers or analysis or math. It's about hormones and emotions. And when you see a third of your life savings wipe away, it hurts. I don't care who you are. I don't care what your disposition is, what your kind of attitude about investing is, or how much you've read Warren Buffett or Ben Graham. It's going to hurt. It's going to hurt because those are just chemicals in your brain that you don't have much control over. And people underestimate that. So one of the biggest mistakes I think investors make is overconfidence, not only in their own skills as investors, but overconfidence in their mental capacity to deal with hardship as an investor. And because of that, I tend to tell investors, and it's something I think about for my own money, whatever you think your risk tolerance is, dial it down by about 20% because that's probably closer to reality over time. And you're going to do a lot better over time. I think if you undershoot your risk tolerance than overshooting it over time. Because if you undershoot it, sure, you might earn lower returns because you have more of your assets in bonds or cash. But if by undershooting it, it keeps you more stable during the most critical investing periods over time, you're going to do much better over a long span of time. So that I would say is the single biggest mistake that investors make is overconfidence.
Morgan, my last question to you is one of the habits of great investor, which is reading. In fact, Mr. Munger and Mr. Buffett, they say read almost one book a week. So let's talk about the big investment gurus which you follow, and which are the investment books which you would recommend to our viewers they should definitely read to become better investors?
Yeah, I think some of my kind of investing role models that I've really looked up to over time. I'd say the top one is Charlie Munger, who was Warren Buffett's business partner at Berkshire Hathaway. And I think what's special about Munger is that he is not only, I think, one of the smartest and wisest men alive, but he can explain things. He can communicate them in ways that are so easy and understandable to average people. And that is an underrated skill in a lot of professions. The ability to take something that is complicated and explain it in simple terms is it's very difficult to do, but B, it is the most critical thing to do when you're trying to teach and change people's behaviors. So I think Munger just views the world in a very rational sense, in a very in common sense terms that make a lot of sense to people. But he's able to take complex situations and distill them down to what matters most, which is a really key investing trait. So he would be who I really look up to the most. In terms of books that have really shaped my thinking, there's a book, it's not a very well-known book, but I think it's phenomenal. It's called The Science of Fear, written by a guy named Dan Gardner, where he talks about kind of the psychology of what makes people scared. And it's really well done, and it really had a big impact on how I think about investing. And then, of course, the classic investing books, The Intelligent Investor, John Bogle's books, Common Sense on Mutual Funds is very good. But really, I think my investing philosophy has been shaped not necessarily by investing books, but by a lot of history books and psychology books. And that's really what I see as the two most critical aspects of investing, is understanding history and understanding psychology. So I like reading books about the Great Depression. I like reading books about World War II, and I like reading books about human emotions and psychology. So Daniel Kahneman's book, Thinking Fast and Slow, is very good. Jason Zweig's book, Your Money and Your Brain, is a really good book. But also I think just reading general history books about how humans have dealt with adversity over time has shaped my view of investing as well.
Wow, Morgan, you've left us with so much to chew on. I'm sure our viewers are taking copious notes. Thank you so much.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.